Hi, it's Jason from iChoice. Thanks for watching. As a mortgage broker, the most interesting part of a home loan is getting the structure right and obviously looking at which lenders can offer the very best rate to save you money in the long term. But look, the very first point of call for me is which banks are actually going to approve the loan that you need. So you've probably heard of the 3 C's of lending. So I'm going to start with what they are. You know, I like breaking up things into 3. First is collateral. Okay, so some banks at 80% will have certain rules, and over 80%, once the loan goes into loan mortgage territory, have certain other rules. Some banks will end up to 95% and capitalise the loan mortgage insurance. Some will go 90% but not capitalise the insurance. Some will actually go 95% plus LMI plus $20,000. So you actually virtually get a 100% loan. Really fascinating product, only one lender does it. But look, even sub 80%, so when you're not involved in loan mortgage insurance territory, some lenders will scale down the LVR, so they won't lend 80% up to a $3 million property. They might scale it down to 70%. Some do 80% up to an unlimited value. Also, others will not lend, many lenders won't lend on an apartment less than 39 square metres or more than 20 hectares. There's a whole bunch of rules about how they like to do it. If you buy 4 apartments on one title, there's only actually 3 lenders that will do it, only one of them being a bank. The next C in the 3 C's is capacity, and that comes to the bank's calculation of your capacity to service a loan. So if you take a 5-year interest only period, the bank might say, well, hold on, it's a 30-year loan, so we'll determine if you can service the loan over the remaining 20 years. That's how many banks do it. Some banks, even if you fix the interest only, you have an interest only period for 15 years, it will still calculate the repayments over 30 years, so it will be much more generous. Some banks will sensitise, meaning if interest rates are 4%, they'll pretend they're 6% when they do their calculation. Some banks take that on all your debts. Other banks will only look at your own debt at that bank at that rate, and any other loans that you have at external lenders, they'll actually take at the actual rate. So it's quite normal for me to actually cap a limit at a certain bank and say to a client, for this one, we actually have to go to another major bank to make it work. It sounds crazy, but it's a bit of a maze, this world of home loans. The last C is character. So for lack of a better term, it's the other things that don't fall into capacity and collateral. So a savings record might be more important to a bank than another. Tenure of employment. Some lenders actually will give somebody a loan if they've only been working for 1 day. Others have a whole different range of variables that they look for. If you're self-employed, many lenders will ask for 2 years tax returns and take an average of the last 2 years profit. Some will take the worst of the last 2 years, and there's 2 lenders that actually just take the most recent year. So there's a whole bunch of things to consider. So as a mortgage broker, the very first step is which banks will approve your loan. Within 2 minutes of talking to a new client, I pretty much know in my head which 2 or 3 lenders are going to be the way to go. Thanks for watching.